Stocks and bonds. Not the chicken stock for cooking or the James Bond movies that might first come to mind. Let me add context to this misunderstanding. When organizations try to raise money to grow and expand their business, they need money. This money can be used for research and development, acquiring other companies, or starting new ventures. They can raise this money through stocks and bonds. Let's start with bonds. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically a company or the government. In other words, companies can borrow money from investors by selling them bonds. Most bonds have interest payments that are paid to you until the bond matures. Once it matures, the company gives you back the money you lent them. Bonds are typically long-term investments that can have terms of up to 30 years. Unfortunately, the return you can get from bonds isn't very high. The interest rate you get from them is very low, usually less than 5% per year, at least for the last 20 years in history. This is because it's less likely for a company or a government to default than a person, so they can borrow money at a lower interest rate. Bonds are a very safe investment because it's always compulsory for the company or government to pay back their debts to the investors. There's one more thing that investors can do with their bonds to make a return. They can sell their bonds to other investors. The other investor could pay for your bond and start receiving the interest payments in your place. But why would you sell your bond? Well, because bond prices change over time, so you can make a return by selling it at a higher price than you bought it for, especially with interest rate changes by the government. Bond prices and interest rates move in opposite directions. So for example, if you buy a bond that gives you a 2% interest per year for $100, and then the government decreases the interest rates to 1%, you could sell your bond at a higher price because it's offering higher interest rates than the current ones available. If the government increases the interest rates on future bonds to 3%, then your bond value decreases. You could have purchased that 3% bond with $100, but you purchased it at a rate of 2%, which is less valuable than the current ones. Now let's move to a more common investment that most people have heard about: stocks. A stock is a security that represents the ownership of a fraction of a company. It entitles the person who buys a stock a proportion of the company's assets and profits. Stocks are commonly known as shares. Companies sell these ownership shares to raise funds. So how much of the company you own depends on how many shares you have, relative to how many there are outstanding in the market. So for example, if a company issues 100 shares and you own 10 of them, you own 10% of the company. Smaller businesses usually issue less shares than big businesses. For example, a small business could raise money by selling shares to a few investors. However, a larger business like Apple can raise money from millions of people. Apple currently has over 16 billion shares outstanding. So how do you make money from stocks? Well, if the company has a profit after paying all of its expenses, this money belongs to the shareholders. So shareholders could get their money back through dividends or through capital growth. The company could give the remaining profits to their shareholders through dividends. In simple terms, a payment out of their profits to you for being a shareholder. This would give you a return. It is a decision that the company makes, so they might use half of the profits for dividends and then reinvest the other half to keep growing the business. Which takes us to capital growth. If the company reinvests their profits in the business, they will keep growing the business in many ways. For example, opening more stores or launching a new product. This means more profits and valuable prospects in the future. Therefore, the price of your share increases in value. This means that you could sell your shares to another person for more than you bought them for and make a return. Shares can also provide you with a vote on certain business decisions. If you own a large proportion of the company, you could have significant influence on decisions made. Stock prices and movements change per country and industry. For example, stock prices for airline companies might decrease in value if there's a pandemic because there's no travel, while technology companies might increase in value if there's a pandemic and everyone is at home using technology products and services. And that's what stocks and bonds are. Revolutionary concepts we should all learn about in school, but unfortunately haven't. I hope this video helped you understand the basics of these instruments. This is Planet Finance. Thanks for joining me. Until next time, happy learning.